Okay, hello everybody. Thank you very much for joining us. I'm Tom Robinson, one of the co-founders of Elliptic, and I'd like to welcome you to the fourth in Elliptic series of webinars where we discuss crypto assets with some of the world's leading financial regulators. We founded Elliptic back in 2013 to help regulated financial services businesses to adopt crypto assets in a safe and compliant way. And the aim of these webinars is to bring together industry and regulators and to help provide clarity in that messy area where decades-old regulations meet disruptive new technology, such as crypto. Over the past few months, we have hosted the likes of Ken Blanco, Director of FinCEN, and Andrea Gacki, Director of OFAC. Those discussions helped cast light on some of the gray areas around crypto regulation, and you can see recordings of those sessions on our website. Our guest today has perhaps done more than anyone to help remove the regulatory ambiguity around crypto assets, particularly for banks in the US. We're very pleased to welcome Brian Brooks, Acting Comptroller of the Currency, who leads the OCC, the agency that oversees the federal banking system of the United States. Thank you for all of you who've submitted questions in advance of this session, many of which we'll be using today. You can also use the Q&A functionality at the bottom of your screen to ask questions during the session. We can't guarantee that they will all be answered, but we will be reviewing those and passing them on to our host, Simone. So I'll be back after the discussion with some further information. But now I'd like to hand it over to our CEO and host, Simone Maini.
Fantastic. Thank you so much, Tom, for that introduction. And thank you to everybody for joining us today. I know we have a very global audience, so good morning and good afternoon and good evening from wherever you are dialing in from. So Brian Brooks, Acting Comptroller of the Currency, has been something of a fairy godfather, if I can call you that, Brian, to the crypto industry during your tenure overseeing the OCC, where you've been providing some much needed clarity on some critical issues, and some as recently as last week, and we'll be getting into that in today's discussion. And Elliptic is really appreciative and grateful to Brian and the OCC for speaking with us today, particularly at what I know is a very hectic time for you. So thank you.
Happy to be here. Thanks for having me.
Fantastic. And look, I expect that Brian's background is pretty well known to most of our audience today. So I'm not going to spend a lot of time recapping that. But having spent some time at Coinbase and Fannie Mae, Brian assumed the post of Acting Comptroller of the OCC fewer than 12 months ago, where he's the primary US official responsible for overseeing the US banking sector. And as we'll discuss today, 2020 was a big year for the ongoing convergence of the crypto and the traditional financial services industries, where we see crypto businesses taking steps to become banks and banks taking steps to offer crypto products. And of course, the OCC has been very much at the heart of that convergence. Helping the crypto industry mature to provide banking services and making crypto safe for banks to handle has also been at the core of our mission. And so we're thrilled to have Brian here with us. So without further ado, Brian, thanks again so much for joining us today and for engaging, of course, with the wider industry. So very welcome to today's Crypto and Coffee.
Pleasure. Where's my coffee?
And I should say, indeed, where is your coffee? I should say it's no surprise that today is our most well-registered and attended event. So there's a lot of eagerness to hear from you, Brian. And I think also, to demonstrate that we're really grateful and supportive of the clarity that you've been bringing to the industry. So I think it's important to start off by talking about the big picture, really, because I think this will help the audience really put into context the work that you've been doing around fintech and crypto and why these topics feature so strongly in your agenda. So I'd love it if you can talk a little bit about why you're so passionate about financial innovation and technological progress, and why you make those topics a key part of your work. What got you to a place where you recognize that those topics are so important?
Well, there are a lot of ways into that, Simone, a lot of ways of thinking about it. But I guess I can tell you the story that I love to tell about when I first discovered fintech generally, before I had ever dipped my toe into the waters of crypto. So there was a time when I was general counsel of Fannie Mae, which at least your U.S. audience members will know what that is. Fannie Mae is, the biggest, most important, and slowest moving company in America. Okay, it's a $3.2 trillion asset balance sheet that is the most important investor globally in housing finance, which is the biggest sector of the economy. And also, did I mention, the slowest moving company in America. And so the CEO of Fannie Mae and I, back in 2015, had a trip scheduled to San Francisco for a meeting with a fintech company. This was a fintech company that wanted to originate mortgages and sell them to us. And so it was a no big deal kind of a meeting. But we thought it would be interesting to go out and meet the first fintech company we'd ever encountered. So we got on an airplane and we flew west. While we were flying, the storm of the century descended on Washington, D.C. and shut down all of the airports for a week. And so we had to spend a week in San Francisco with one day's change of clothes, and a toothbrush. And it was like, what should we do? We're stranded here. And we thought, well, since we're here, why don't we all go meet all the fintech companies? Let's find out what this is all about and what they're doing. And that week was a transformational week for both of us. Interestingly, we both 3 years later left Fannie Mae and entered fintech on a full-time basis, because what we saw was that the disruption that was available to take this incredibly slow-moving and yet incredibly important sector of the economy and make it faster and cheaper and more reliable and less risky and all of these things was mind-boggling. And why it was that those solutions hadn't been deployed, as far as we could tell, was basically indefensible. And so we brought those learnings back to our perch at Fannie Mae. We created a fintech incubation platform at Fannie Mae, and we did amazing things in a short amount of time in terms of shortening cycle time, relieving sellers of mortgages of all of their legacy rep and warrant liability, which then made it easier for them to originate new product because it was less risky for them to do that. There were all kinds of things that we did in our little sector of housing finance that persuaded us that technology was moving much faster on the West Coast than people on the East Coast realized, and we could be people who injected that into our gigantic, but did I mention really slow-moving business. And doing that transformed Fannie Mae in lots of ways. It's a very different company today that's able to do things with less risk. It's able to do things more cheaply. It's able to scale and serve more people and more categories than it used to be. It was an amazing learning experience. And so that's what got me down the rabbit hole in the first place. Crypto, I would say, is sort of an extension of that insight, but it's also something that's more fundamental. And so, although this may or may not be directly relevant to your question, let me just close on this note and we'll see where it takes us. And that is, you mentioned in my introduction that one of the things I've done is I've made it easier and clearer for banks to adopt crypto. I would actually flip the script on that a little bit. What I've tried to do in my time here, like some of my really distinguished predecessors in the past, is I've tried to ask questions about what does it mean to be a bank in the first place. And I think the recognition we've had in my time at the OCC is crypto is banking. It's not that banks are okay, trading Bitcoin. It's that Bitcoin and ETH and stablecoins, they are banks. Blockchains fundamentally are banking because what they're doing is allowing the transaction of value across networks, which is what banking has done for 500 years. They're doing it in an orthogonally different way, but that's what banking's about. And so when you see us, for example, as we will do soon, start chartering as banks, companies that are crypto companies, you'll start to understand that we're not necessarily trying to make it so that big banks can dominate the crypto market. We're trying to tell crypto participants that a bank charter might be the right form for you to do what you're doing. And there's a lot to unpack there, but I think that's the vision.
Thanks, Brian. Yeah, there's an awful lot to unpack in that. I think the first thing I would say is at Elliptic, we have a company value of turning challenges into opportunities, and it sounds like that's what you and your colleague did in San Francisco. Secondly, it sounds like maybe we need to send everyone on a San Francisco week-long boot camp. Hopefully they can have a similar experience as you do. And yeah, certainly when we talk about chartering, we're going to get into that in a lot more detail later on in the conversation. But I think that's an important clarity that, as you say, crypto is banking. It's just about how we can create an environment and infrastructure to make it happen in a safe and compliant way. So you have given quite a good segue to my next question, actually, which is really when you're talking about, Fannie Mae is slow, but you were able to bring change there. So when you think about your passion and your vision for financial innovation, how does that align with the work of the OCC? What was your first reaction when you were considering a role there? Because I know a lot of people who work in this space or feel passionate about it. A regulatory agency isn't the first place that they would go to work on that.
Well, so I guess what I would say is, I think that there's something different about this agency versus almost all other agencies in the U.S. government, and I'll say more about that in a second. But second, to me, whenever you are thinking about a job, the way I think about it is, is it the right platform for me? Because it's sort of like I said about my answers to your questions before we got on here. No matter what questions you ask me today, there are certain things I'm going to say. And it doesn't matter if you ask me what time of day it is or what's my favorite color, I'm still going to give you certain answers because that's part of my message that I will give. And it's the same thing to me about platforms, which is, this is a great platform if you have an agenda. And clearly I showed up here with an agenda on day one that I've been thinking about for 25 years. So for me, it's not about, oh, I want to go work in the government. It's more about the OCC is in charge of the financial system, and I do have a vision for what the financial system can be. So if you put me there, that'll be the vision that you'll hear about, right? So let me just say one word about why the OCC is really different, though. And I've just noticed, just looking at the list of attendees here, that there are a number of OCC people and alums on the line, including, without calling out her name, one of the most important visionaries who's ever worked at this agency. And the reason I think this place is really different is the OCC, going back 30 or 40 years at least, has been sort of in the prow of the boat, seeing the future. And what I mean by that is, at every important juncture in economic history, whether it is about bank charters or about technology or the scope of the way that people receive their financial services, it's the OCC that has been first to recognize it and has adapted to it. So just to give you a couple of examples, there was a time in the 60s when computers, mainframe computers, were first being adopted by big businesses, including banks. And banks were not likely to invest in mainframe computing unless they could sell their excess data processing capacity at a profit, because at the time, banks weren't using enough of those computers to justify the investment. And so the controller at that time came out with a ruling that said it was a permissible bank power, not only to do actual banking stuff like making loans and taking deposits, but also, to the extent a bank used computer systems to do that, and there was excess capacity, to sell computing power to people who weren't banks, for various purposes. That was hugely controversial, but the controller at that time realized that, hey, if we're going to migrate banks onto a computer platform and away from book entry, we're going to need to make it easier for banks to do that by allowing them to sell that as part of the business of banking, and that was allowed. Fast forward a generation to the early 90s, and synthetic financial products are being offered by a bunch of competitors that are not thought of as banking products. A great example would be variable annuities, which look a lot like a savings account. You put money in, you earn a rate of interest, sounds like a savings account. And the question was, could banks sell variable annuities? It was enormously controversial. Annuities were usually sold by insurance companies, not banks. And the insurance lobby sued the OCC, over its authority to do that. And it was so controversial that it went all the way to the US Supreme Court before the Supreme Court validated the OCC's right to say that variable annuities were a permissible activity for banks. You fast forward to the present moment, and I've said this in many different fora, there are two major trends going on in the economy right now. There is a trend toward Fintech. That's what I call the unbundling trend, where more and more people are looking to achieve a bespoke financial services experience away from their depository institution. So that's why some of these payment companies and some of these marketplace lenders have gotten so much adoption. It's precisely because they're not deposit takers, right? They can focus like a laser on one thing, and customers like that. So that puts pressure on banks, but it also puts pressure on us to think about, if those are banking activities, how can we keep them in the fold of our chartered institutions? But the other most important trend, and this is a longer term trend, is the trend toward decentralization. It's the same trend that drove us away from libraries and post offices and onto the original internet. And that trend inevitably will transform the delivery of financial services. And I say inevitably because single points of failure and vertically integrated stacked type of tower companies are rigid, they have no incentive to innovate, and eventually they are subject to risk and resiliency, right? Because there's a single attack vector, versus networks are highly stable. And so my thesis is, it is inevitable that the future of finance will go on the internet like the information age did 25 years ago. And we need to prepare banks for that world. And we also need to prepare the bank charter for that world. Okay, so that's my thesis about where all this is going, is we can't stop it. I'm neither in favor of it nor against it, but I recognize it is real. And my job then is to put a frame around it that protects people from bad outcomes while allowing markets to function.
So with that said, then this is a good time, I think, for us to talk about the charter and, you know, some of the things that you're doing, given that recognition that you've just outlined, that are considered in some corners to be quite controversial. You know, one of the exciting developments in crypto in the last year has been seeing crypto businesses applying for those banking charters with the OCC, and you've clearly been instrumental in spearheading that work with the introduction of the new Fintech charter. Can you explain the implications of these recent applications for the development of financial services in the US, and how is the OCC judging those applications that have been submitted from crypto businesses?
Well, so let me first of all talk about why it's important, and then I'll talk about the way we're evaluating these applications.
Yeah, sure.
So if you think about the way crypto has worked heretofore, it's an interesting technology. Investors are interested in buying, you know, shares of these networks, and that's what these tokens really represent, are shares of networks. But at the end of the day, you can't really have a fully functioning crypto economy because every transaction at some point has to off-ramp into fiat, right? And so you've got this clunky connection between all of this cool stuff happening on chain. And then at the end of the day, I need to find a bank to turn those things into dollars, or a bank or an exchange to do those things. And so the connective tissue between crypto and fiat is an inherent inefficiency. For those of you old enough to get the joke, it kind of reminds me of my first car, which had an 8-track tape player. And so if you wanted to play a cassette tape, you got this weird little insert, and you put the cassette tape in the insert, and you'd shove the insert into your 8-track deck, and a lot was lost in translation. And that's what happens today. Every time you have to pay a 2% fee to convert your Bitcoin into dollars, that's the equivalent of the 8-track tape deck, you know, not really working very well with the latest technology. And so what has to happen for us to have a world of a crypto economy where nobody ever needs to go off chain, where everything's fully integrated and fully seamless? I think what's necessary is for you to have crypto banks that are able to hold stable coins that reflect value denominated in the fiat currency, but that is a chain native asset. And you need to have real cryptocurrencies over here where they interact directly with each other with no need to ever off-ramp into fiat, right? Fiat ultimately will be a legacy thing of the past, you know, in much the same way that people think about pennies or, you know, shillings or whatever it was that people used in the 17th century. You know, those things will eventually, I think, go away in favor of a chain native representation of value. And so that's what has to happen. But for that to happen, you have to charter as banks companies that are able to offer the full suite of services that we all need as human beings. Because think about it, however cool crypto is, you still got to pay your student loans, right? You got to pay your taxes. You need to be able to finance your education, buy a car. I mean, there are things you have to do. And right now, you really can't do that in crypto because of this need to exit your investment asset into a bank account so that you can go use your credit card. That'll change. It may not change next year, but it'll change in 10 years. And what we're trying to do is to envision that world where you have a fully integrated crypto economy that doesn't have to have a clunky connection with the old world. Imagine, for example, if I could send you an email, but the only way for you to read it was to print it off on your printer. You know, that's kind of the way it is today, or in banking. We need to go to a place where you can read the email in the same format I sent it to you with no need to download it into the old style. So, okay, I promised I was going to say something about how are we evaluating these charters. Let me talk about that for a moment.
Great.
So the way we're evaluating these charters is, first of all, with the same rigor and the same risk management that we would evaluate any bank charter, okay? So whether people are engaging in finance and financial services in fiat or in crypto, the issues remain the same. If you're a borrower and I'm a lender, it's important that you repay my loan. And I need to make sure that you as the lender have some way of evaluating creditworthiness. And we will apply the same standards there that we would apply to any bank, right? Because people are still doing the same things. They're just doing it, you know, on a different platform. Same thing with sort of financial viability. You need to be a profitable company because we don't charter banks that are likely to fail. We only charter banks that have a path to profitability. We look at the management of the company to make sure that you have people who are experts in the relevant technology, but also in the relevant risk management and credit, you know, skill sets, all of those kinds of things. So when we announce our first crypto bank charter, which, here's my teaser, will be soon, what you'll see is that we've applied all of the rigor. And so we're not trying to bring risky businesses into the banking system, but what we are trying to do is make the charter flexible enough that it can accommodate different ways of doing business, okay? All by means of creating an integrated, fully online, fully internet-based financial experience, which has never existed before.
Excellent, thank you. So I was going to ask you when you think you're going to be announcing one of those charters, and you've said a couple of times soon, so I'm going to translate that as, the next few days, hopefully. So that's something for us all to...
Just checking what time it is.
Excellent. So related to those applications, though, I am curious about, the level of preparedness from an operational and a financial crime risk and compliance point of view that you've seen in those applications. Are the fintechs that are applying, are they up to scratch when it comes to, comparing them with the other institutions that you charter today? And, do those insights translate into advice for fintechs and crypto businesses that want to get chartered? What can you say to, some of the audience today around that?
Well, look, that is a great question, and it's especially a relevant question at an Elliptic conference, right? Because this is what you guys do. So let me just say, first of all, there's been a lot of talk over the last couple of years about the travel rule, which I think most people on this call know about. And then just in the last month or so about this new FinCEN rulemaking, talking about the use of hosted and unhosted wallets and what kind of risk management needs to be done if you're dealing with unhosted wallets. So I would begin by saying, on the one hand, that obviously there are very real, criminal conduct concerns in any financial market. That is no more true, but it's also no less true in crypto than it is any other place. There is a certain amount of money laundering and terrorism financing and fraud that goes on in any financial market. Banks have found ways of managing that, more or less successfully for, decades, if not hundreds of years. So in terms of a maturation perspective, crypto is a younger industry, not founded by people from banking. And so, these are not things that are front of mind, I think, in what they're trying to build. What we need to do, those of us who kind of live in this sector, however, is we need to do a better job of, first of all, showing that we understand the different tools available to us to manage the risk of you could call them compliance violations if you want to be euphemistic, or you could talk about money laundering and terrorism financing, which is really what goes on. And we need to be able to tell a story that is credible, that says, hey, we can never eliminate this risk, but we can reduce this risk to background levels that have been acceptable more or less in the mainstream financial sector. And that doesn't mean, for example, that we can't use unhosted wallets, but it does mean that we have to take seriously the possibility that unhosted wallets could belong to bad guys, and there must be some way that we can deal with it. So how do you do that? Well, if you look at the FinCEN rulemaking that came out, or the related President's Working Group statement on stablecoins, which had some similar language, those groups were careful to be what I call tech agnostic about how to achieve compliance. So sure, you could comply if you simply did not allow transactions to unhosted wallet addresses. But of course, if you did that, what's the point of crypto, right? Or you could have a risk-based approach, which is generally what regulators look for any risk, which does not mean perfect compliance, but it means reasonable compliance relevant to your risk profile. And that might include things like, for example, geofencing sanctioned countries and having some way where you can ping your send receives against a blacklist out there. And it may also include using an elliptic type of service or building protocol level solutions to allow you to validate that the person you're sending to isn't somebody who's a bad guy. Now, whether the right approach is to actually collect name and address information for that person, or whether it is instead to simply validate in some fashion that whoever that person is, they're not a bad guy, one could debate that. And I think that's what regulators talk about. But at the end of the day, I think that the most promising future for crypto will require one of two things, and maybe both. First of all, Simone, it's going to require a company like yours to achieve broad adoption so that there's confidence that these chain analysis technologies can trace adequately, can do enough to get regulators comfortable that the odds that money is being sent to Osama bin Laden are really low. I know how that works, but it's possible not everybody on the call does. I know how it works because when I worked at Coinbase, I had a group that reported to me whose full-time job was doing chain analytics, using Elliptic and CipherTrace and chain analysis, among other things. And we know that we worked directly with FBI agents and U.S. attorneys' offices, intelligence officials around the world to catch bad guys, whether they were human traffickers or drug runners or terrorists. And we did that every day, and we won awards for doing that. So we know how well that works. At a senior policy level, I'm not sure that that story has been told loudly enough. So I think we need people like your company to very loudly talk about what you do and why you're effective, right? Because in the absence of that, there will always be a drumbeat of we can't allow unhosted wallets. It's one thing to send an email to an unknown internet address. It's another thing to send money to an unknown internet address. And so we need to build confidence. The second thing is, I think that if we believe in decentralization, which is why all of us are in this world in the first place, we also have to recognize that building some kind of decentralized approach to this. So it may not necessarily be a corporate software package that's doing your analytics. It may be something that is built into the protocol, or it may be that they're blockchain and sort of validation tokens that are able to say, yes, this network address that you're going to has no history of being blocked. It has no history of a follow-on send to a bad person's address or whatever. And that could be an evolutionary thing that exists on-chain in the first place. That's probably the ultimate place. And my guess is that as Elliptic builds out its own business plan, that's probably the kind of thing that you're looking at. But convincing the regulatory community that technology problems can be solved with technology as opposed to with prescriptive bans, that's the challenge. And there are people like me that are open to that, and then there are other people who are more skeptical. So showing that and talking about that every day is probably a big part of the solution.
Great, thanks, Brian. And I know a lot of people on the call will have taken that as a call to action to really speak clearly and consistently about the technology that we have got, and actually some of the innovations that have come out of the crypto sector that are making the fight against financial crime more effective than they have been in traditional industries. So yeah, thank you for that. So I want to move on because time is marching on here. So we've talked a lot about crypto businesses and what they're doing to start looking more like banks. So now let's talk about some of the issues impacting banks and financial institutions when it comes to crypto. And so an obvious place to start really is the news from last week coming out of the OCC, where you issued an interpretive letter clarifying that US banks can use stablecoins for payment activities, which is clearly a huge step forward, paving the way for really major payments innovations in the US. But on the flip side, there's been a lot of attention on the risks related to stablecoins. Throughout the last 12 months, including at the G7 and in Congress, we can see the proposed Stable Act. So can you take a minute to explain the significance of last week's interpretive letter and, also what you see as the main challenges facing stablecoin issuers as they're seeking that regulatory clarity and approval?
Yeah, absolutely. So let me just start by saying this was the second letter that we put out that touches on stablecoins. And I see this letter, which I kind of personally refer to as crypto letter number 3. I see it as less about stablecoins and more about banks connecting to networks. Okay, so we put out a letter months ago talking about banks supporting stablecoin projects by, among other things, holding reserve deposits and doing other things. That's fairly easy stuff. The much more interesting stuff is envisioning the future role of banks on blockchains. And what our most recent letter said was banks can connect as nodes on blockchains for the purpose of supporting and transacting payments. So if you think about it, the networks that are transacting these stablecoins are not their own separate networks. They tend to be the Ethereum network or the Algo network, or there are a number of other networks that some of these interoperable stablecoins are now able to connect to. And what we're saying is, hey, a bank can be, a staker on the Ethereum network, and in doing so, will then be able to transact and validate transactions that are, creating Ethereum tokens for them as a validator, while maintaining the network that is the network that stablecoins transact on. So it's a much more fundamental letter than just talking about stablecoins. But the point of that is to say, listen, we've already got banks that are maintaining payment networks. Think about the big banks that are part of the automated clearinghouse system. that's a small number of banks versus the Ethereum blockchain is maintained by millions of nodes. But still, it's long established that banks can get together, they can create payment networks and use that to transact payments across the system. All we're saying is the big bank oligopoly, which is what that network is, or the government monopoly, which is what Fedwire is, are not the only ways that banks can transact value, right? The role banks have is not to be oligopolists. The role banks have is to allow their customers to transact value with other people. And if one way of doing that in a much more interoperable way is using blockchains, because again, blockchains are just internet protocols, then we're happy to tell banks they can do that. So that's the big deal here, is it gives banks a role as nodes on networks and says you can not only use the bank monopoly networks, you can use the open networks to send value. Now, that will open up a world. Remember, just a moment ago, I was talking about imagine a world where nobody ever has to download into or downshift into fiat. It will open up a world where you will have people who have investment assets in cryptocurrencies, and when they're ready to make a payment, they will shift some of that into a stable coin, and their bank can transact the stable coin without ever leaving blockchain. And everything can happen inside of the network without ever having to downshift into the old technology. That's what that letter was all about, which is really huge. And for those of you who read my op-ed yesterday in the Financial Times about decentralized finance, ultimately what that suggests is that banking itself, the act of lending and paying interest and other things, may become algorithmic itself, and that'll be a lot easier when stablecoins become the price stable unit of exchange within the crypto economy.
So you talked about crypto letter number 3 there, and we can debate the relative importance of the 3 letters, but I think a lot of people also see the letter around custodying of stablecoins as equally impactful, and I'm really interested to understand a little bit more about what goes on there behind the scenes in terms of the thinking that gets you to publishing a letter, and why do you think it took so long really for that clarification to arrive for the banking sector, given that those questions have been floating around for several years?
Yeah, well, so I guess I would start with one thought, which is much as I'd like to take credit for all of this stuff, the work on the original crypto custody letter started 2 years before I got here. So the lawyers in the OCC legal department have been looking at this issue for a long time, and I think had some pretty considered views. The problem generally is that governments don't usually move fast. Remember what I said about Fannie Mae being the biggest, most important, and yet slowest moving company anywhere? Governments are not famous for making decisions because there's risk involved, and a lot of people who have leadership roles in government plan to stay in government their whole careers, or they want to work in a law firm representing clients in front of the government. It's just a very risk-averse environment. So what I did here was not have the original conception, let me be clear, but what I did do was show up and say, hey, let's get this out the door. Markets are moving faster than you realize. The US is losing ground. This at this point is a competitiveness issue. Other countries are actually moving. We can't let that letter sit on the shelf any longer. So what I did is I think I brought a different pace. And I like to think I brought some ideas, but more it was about the pacing and the management of let's push this stuff out the door. Having said all that, I mean, all of us come to these jobs with the experience that we have. And I spent 6 years in Fintech and 2 years in crypto. And I think I do know some things that most bank regulators don't about these things. And that's been one of the really gratifying things about this role is I've been able to work with my peers who are heading other agencies. And I think they've generally recognized that while they know more than I do about certain things, I probably know more about crypto than anybody else does. And so we've been able to work with me kind of being a de facto thought leader on those issues. But again, my thesis here is there are 2 macro issues going on in the economy. There's unbundling and there's decentralization. If we don't get out in front of that, we'll just lose, right? Other countries get this. And my role is to say the United States gets this too, and we can catch up in a hurry, which I think we have.
Great. Okay. So that, another question then on banks. So, I speak to the compliance teams at banks every week, and we're only speaking to more and more as the weeks go by. And, consistently the number one concern that they raise continues to be related to the lack of regulatory clarity. And, I know that, obviously that's behind a lot of the work that you're doing and what you're trying to seek to address with the interpretive letters. But while the letters can clarify what is permissible. There's still a lot of ambiguity when it comes to what's actually expected from a compliance program, from a practical perspective, for example, when it comes to actually the custodying of digital assets or stablecoins. So, when do you think we can expect that further clarity around this? And do you agree that it's necessary in order to give banks the confidence they need to start doing some of these activities?
Well, so literally just this morning, I woke up and I had a message from a friend of mine who runs a fund that's invested in crypto assets, among other things. And this friend told me that he's already seen some changed bank behavior just over the last 3 months. So I would first of all say whether and how much more clarity is needed is kind of an empirical question that we don't know enough about yet, because we pumped all of this stuff out in a very short amount of time. So if you think about what we've done in terms of clarity already, we have 3 interpretive letters, one on custody and crypto assets, one on stablecoin reserves, and then one on connecting to blockchains and payment networks. We have my piece yesterday on decentralized finance and what that means for the future of bank regulation. And very shortly, you'll see the first crypto bank charter come out. Okay, so all of those data points will be out there. And I think at that point, and I'm sorry, and I should say one other thing. We also have this notice of proposed rulemaking about something that we call fair access to financial services, which was not motivated by crypto, but crypto is an example of something that would be affected by this. So for example, banks cannot say under this rule, assuming that it's finalized, that, hey, as a category, we will not bank crypto companies. We won't allow you to have a deposit account. I know what that's like, because at Coinbase, we literally had people not willing to carry our payroll account. And it's like, why not? There's no credit risk, there's no anything, but it was like, we just don't want to touch crypto. Well, our fair access rule would not allow that. Our fair access rule would require banks to identify and manage those risks and onboard customers where the risk can be managed, as opposed to just saying as a category, we don't like crypto. So all of those things have happened. And I think that's a lot more clarity than existed 9 months ago when I walked in the door. So I'll take some amount of credit for that.
Yeah, no question.
But look, in terms of other things, I mean, there is a process at the OCC for people to request information, much as you might request a no action letter at the SEC on a securities issue. And if someone said, hey, we're a bank and we're going to enter this custody business and we plan to do all of these things, would that qualify? Like, do we have the legal authority to do it? You can send us a letter, and if it's a legal question, we'll respond by a letter. Or if you're already a bank wanting to do something, every bank has an examiner in charge, and you would consult with your examiner in charge, who would run that up the chain and get you some kind of non-objection that would tell you generally what's allowed. So I think that's really the way to think about it. But I come back to, at the end of the day, if we're correct in this industry that the demand for these services and these tokens is high enough, banks will figure it out. The example I always give is Uber, where Uber did not wait to launch their business until they had perfect clarity from the taxi cab commission in every city that it was legal to have a ride-hailing service. What they knew was once 50 million Americans wanted to ride Uber, the taxi cab commissions would figure it out. And that's sort of my thesis about crypto is if people don't want this, none of this matters. If people do want it, the problem will solve itself. And I believe that decentralization is inevitable. So if you believe that too, then these issues are really not issues. They will be figured out, because in a market economy, the consumer is king.
Great, thank you for that. And I want to pick up on a couple of those points in a moment. But I do want to just talk about the op-ed from yesterday. For anyone that missed it, Brian authored a really interesting opinion piece in the Financial Times that was published yesterday, where you discussed the concept of a self-driving bank, based on decentralized finance, or DeFi. So can you just briefly explain what you mean, first of all, by a self-driving bank?
Yeah, so I'm pretty excited about that term, I have to say. I've already seen it stolen by a couple of conference organizers literally in the last 24 hours, so that's how you know it was successful. The concept basically is this, is look, what we do at the OCC and at all bank regulators really, is we administer a whole set of rules that are mostly designed to constrain bad behavior by bankers. We really do very little about banks. It's mostly a set of rules that say, hey, boards of directors cannot engage in self-dealing loans with themselves, or bankers who commit fraud might be banned from the industry or have to pay a penalty, or we need people to make credit decisions based on a list of factors, and if they don't, then they'll get in trouble. It's mostly about individual behavior. And when we charter a bank, by the way, we issue a charter to a group of organizers. So you have to have 5 people and a board of directors in order to get a bank charter, etc. The question I ask in the article is, if you look at these DeFi protocols, the more mature DeFi protocols basically are offering everything banks do. They offer payment services, they offer a chance to engage in exchange, they offer lending and borrowing options, and a whole bunch of other things. And there are no human beings associated with them. They're just open source software doing all that stuff. So it's very like self-driving cars, right? Historically, all the rules of the road were about human beings. Don't drive while drunk, drive the speed limit, use your turn signal, get a driver's license. Those aren't rules about cars, they're rules about drivers. What do you do when all of a sudden there is no driver? Who's responsible? How do you make sure the cars, who are you regulating? And you're no longer regulating people, you have to regulate the thing. And so what I talk about in the article is there could well be, and I think we're on the way to having a series of bank-like software packages where I can simply log on to an internet address and I can say I need a loan at 4% for 3 years, and that DeFi protocol will find that for me. And I will never know where the money's coming from, and it won't matter because I'm going to lock a certain amount of value in the smart contract, which will release payments. The payment will be distributed algorithmically, and that'll be the deal. All of those things are what banks do. Who's going to oversee that, right? And what I posit in this article is, imagine a world where we were granting charters to software as opposed to individuals. We could say, yes, that software protocol, which we've now examined at the code base level, meets our requirements. It is fair. Anyone who logs on is getting full disclosure of what they're getting. The loan terms of the smart contract do what they purport to be doing. So we're good with that. And now that banks can connect as nodes on blockchains, the way that the OCC might examine that is we might simply plug into that blockchain. We could plug into the maker blockchain, for example, and we could look at the code base. And as we saw things that might be violations, we might step in and adjust the code base or find some way of blocking a change or something else that would violate the law with no human beings being involved. But I mean, ultimately, that's what crypto's about, right? Is to migrate the stuff that currently has a high friction because of human involvement into a world that has no friction because it's fully decentralized. That's the ultimate state that we're trying to get to. But it requires us thinking about the idea that it's not just that Bitcoin might be a good way of saving money or ETH might be a good way of building contracts. The entire financial services experience may migrate to software, in which case, what should we do since we're supposed to protect people from bad outcomes?
Yeah. And I think, look, there's no question that regulating these kind of entityless entities is going to be a huge challenge. I think you yourself said in another interview that whoever figures that out should get a Nobel. So we'll see if I don't know, in 10 years' time, Brian Brooks is on the receiving end of one of those when you've figured out how to regulate these so-called self-driving banks. So look, me for
that, I'll release 10 ETH tokens for me, just right here. See you in Sweden.
Very good. We'll see you there. Look, we are running out of time here, and there are a couple of things that I want to just touch on before we wrap up. So, last 2 questions, really. First of all, what do you see as the priorities for US policymaking when it comes to crypto that you'd like the next administration to keep in mind? What's your call to action to those that are following in your footsteps?
I want to be careful how I say this, but because I'm going to make 2 points that might sound like they're in tension with each other. The first is, it is super important, not just in this country, but globally, that we stop politicizing tech. Somehow, for a variety of reasons, technology itself has become highly, highly political. And the ability of the United States to continue to lead in innovation, for Silicon Valley to deliver the life-changing things that it's delivered from Google to Amazon to smartphones and everything else, is at risk if tech becomes a Republican versus Democrat issue, or a Labor Party versus Tory Party kind of an issue. We have to resist that. Here's the statement that will be somewhat in tension with that, which is, on the theory that hard facts make bad law, we had a really, really awful event in the United States last week, as everybody knows. I mean, we saw things that were not worthy of a mature democracy in the 21st century, not worthy of the heirs of Thomas Jefferson and James Madison, okay? What has followed from that, however, is truly chilling. So now you've got payments companies saying that they won't process the payments of people who are on a certain political party who voted one way on a contested political issue. You've got MasterCard and Visa beginning by saying they don't want to process payments for pornography, but now saying they also might not want to process payments for guns or for tobacco or a series of other things that aren't illegal and that people want, and it's their money. We live in a world where not only information, but also money might be controlled by a handful of elites who might not like the way that any given one of us thinks on a given issue. This is what decentralization is about. In the world of crypto, there is no CEO to deplatform you, right? Crypto is about freedom. And if you didn't believe that freedom mattered last week, you should think it matters today. That's the call to action. We have to build this stuff to avoid tyranny at some level.
Thank you for that. I think, yeah, really powerful message. And I think chilling is the right word for all of us to take forward and take some responsibility in what we can do with this. Okay, I promise one last question then. So, as I said at the top of the call, there is a lot of speculation that you might step down this week, what's going to be next for Brian Brooks. So, I know everyone would just love to hear a little bit about, what's on the horizon for you.
Well, look, I obviously can't comment about my particular timing, but in this government, like in all governments, we have elections. There's going to be a new administration, and the new administration gets to pick their people. So the beauty of this office, I mean, as I look around here, this office is filled with memorabilia of prior controllers, both Democratic and Republican, who have contributed to the work of the agency. There will be another controller, and it won't be me. My hope is that what I've done here is try to do a little bit of pathfinding, and to chart a course. Because as I said at the beginning of this, the OCC's role for a long time is to be right there at the prow, looking over the horizon to see what's coming. And I'm very hopeful that whoever my successor is won't change those things. There'll be a little bit of a different political cast, and they'll focus a little bit more on certain things than I did. But I really don't think that the innovation that we've done here is political. It certainly shouldn't be. The future is what the future is, and you might like the internet or not like the internet, but it's coming and it's here. And regardless of what your political party is, trying to hold back the tide is a fool's errand. You need to allow it to flourish. You need to allow people to aspire and to invent. That's just the human condition. So look, what happens next for me is I'm going to have an amazing month of vacation. And I hope to stay in touch with everybody in this community. There's a lot more we're going to do together in the future, I'm sure. Meanwhile, you can find me on a beach somewhere, and I will resurface in a month's time.
Great. Well, look, I'm sure everyone here will agree that you deserve it. And as you made clear during the call, this isn't about being pro crypto or pro any kind of technology. It's about finding the clarity of vision about what's going to be transformational, and championing that so that the US can be a competitive place to do business. And I think everyone here will agree that we're really appreciative of your efforts and the vision that you've brought to that. So look, thank you so much for joining us today, and for all of that body of work. It's been a real pleasure to talk to you, and on behalf of the whole audience, thank you for candidly sharing your views, and we wish you all the best for the future, and as you say, hope to very much keep in touch. Brian for Prez, someone has just put into the chat there, so I think on that note we can wrap it up, and I will hand it back to Tom. Thanks, Tom.
Thank you, everybody.
Thank you, Maini and Brian, for a fascinating discussion, and enjoy your time on the beach, Brian. So this, as I mentioned, is just one of a series of similar webinars we have with financial regulators. If you go to our website, you can see recordings of our previous webinars with Andrea Gacki from OFAC, Ken Blanco from FinCEN, and others. And we'll also be hosting further events of this type in the future. We have a number in the works, and if you'd like to be kept in touch about these, you can go to our website and sign up for our newsletter. But thank you to the hundreds of you who tuned in today. Thank you for joining us, and enjoy the rest of your day. Thank you.